Welcome back to Talk Tickers. This is the show where we grab the fire hose of earnings season and try to siphon off just the high-octane fuel for your portfolio.
We strip out the PR fluff and get straight to the numbers that move markets.
Exactly. Today is Friday, January 23rd, 2026.
And we have a heavy hitter on the desk today. We were breaking down yesterday afternoon's print from the absolute king of the operating room, Intuitive Surgical.
Ticker symbol ISRG.
Yeah. This is one of those companies that, it basically defines an entire industry.
The robotic surgery giant. Now, before we dig in, let's do a quick vibe check on the market reaction because it's interesting. The stock is trading up in the after hours, moving from around, 525 to 540?
Something like that. It's about a 2.7% bump.
Which is positive, sure.
But if you just glanced at the headline numbers, you'd probably expect a much bigger green candle. It feels muted.
That's exactly it. I'm calling this the beat but debate quarter. They absolutely crushed Q4. Really impressive numbers.
Crushed it.
But the forward guidance has the market, tapping the brakes a little.
So that's the mission today. Parse that gap, the flawless execution versus the slightly steeper climb ahead.
Let's do it. So headline financials first. Just to set the stage, revenue came in at $2.87 billion.
Which is up 19% year over year. And the street was looking for $2.76 billion. So a solid beat.
Over $100 million. And the bottom line?
The bottom line's even better. Non-GAAP EPS, $2.53.
Okay. And consensus was what?
$2.27. So they beat earnings by 11%.
Beating by double digits usually gets you more than a 2% pop in the stock.
You'd think so. And don't forget the war chest.
Oh, right. The balance sheet is just a fortress. $9.03 billion in cash and investments.
That cash pile is significant. It gives them so much optionality. But you know as well as I do, with Intuitive, the dollars are just the output, the input, the real heartbeat of this company.
It's all about procedures.
It's all about procedures.
Yeah.
The robot and instrument model.
Right. So peel back the layers on procedure volume for us.
It was strong across the board. The core business, Vinci procedures, up 17% globally.
Which is a very healthy number for a company this size.
It is. But the real star, and I think the one that deserves more attention, is Ion.
Their lung biopsy platform.
Yeah. Ion procedures were up a massive 44% year over year.
44%. That's just incredible growth. Why is that segment exploding right now?
It's a combination of things. It's solving a huge bottleneck in diagnostics. Lung cancer is notoriously hard to biopsy when the nodules are deep in the peripheral lung.
The old ways were just too risky or inaccurate.
Exactly. Ion allows for these minimally invasive, super accurate biopsies. So as lung cancer screening ramps up, you're finding more nodules. Ion is the tool that catches them.
It's becoming the standard of care faster than people realized.
Much faster. It's a flywheel. Ion finds the cancer, and then the Vinci probably removes it.
So when you combine everything, what's the aggregate growth?
Total procedure growth was 19%. And that's the number that really matters because it drives all that high-margin instrument and accessory revenue.
The razors for the razor handle.
That 19% figure is the engine of the whole P&L.
Okay, so double-digit beat, procedure growth is nearly 20%, and yet the stock is only up 2.7%. This brings us to the debate part.
Right, because the market is a forward-looking machine. It's looking at 2026. But before we get to the guidance, we have to talk about what drove this quarter, because we are in the middle of a massive product cycle.
You're talking about the Da Vinci 5, the DV5.
The DV5, their new flagship system. And if you look at the placement numbers, this transition is happening so much faster than previous cycles.
I saw that. They placed 532 systems total. How many were DV5s?
303.
Wow. So more than half the placements are the new model already. And the trade-in dynamic is accelerating too. 146 trade-ins this quarter.
Yeah, up from just 62 a year ago.
That's a huge jump.
It makes sense. Hospitals are swapping out their old Exicas for the new DV5s. But practically, that's a huge logistical feat. It shows that demand isn't just a nice-to-have, it's we need this now.
So what is driving that urgency? Is the DV5 just that much better?
It's a mix, but the tech upgrade is real. Surgeons want the efficiency. But there's a specific regulatory win buried in the transcript that I think is crucial. It's about cardiac surgery.
Oh, I saw this. The FDA clearance.
Correct. FDA clearance for cardiac procedures on the DV5. Now, there is a caveat.
Using the non-force feedback instruments for now.
Right. But this opens up a very specific, very high-value total addressable market.
Management gave a number on this, didn't they?
They did. They estimate the TAM is about 160,000 procedures annually. Right now, they're only doing about 17,000 globally.
So getting the DV5 cleared here is a license to go hunt for that remaining gap. That's almost a 10x growth opportunity in just one specialty.
It is. And the tech is what unlocks it. The DV5 has like 10,000 times the computing power of the last generation. It's designed for force feedback.
So surgeons can literally feel the tissue tension through the controls.
Exactly. Once that's fully unlocked for cardiac, it changes the game. It bridges that gap between the feel of open surgery and the precision of the robot.
So the product cycle is humming, the adoption is there. Let's pivot to the elephant in the room. Why is management guiding for a slowdown in 2026?
Yeah, let's talk about the speed limit. They guided 2026 procedure growth to a range of 13 to 15%.
And just for context, 2025 finished around 18% growth. So 13 to 15 is a distinct step down. It's a deceleration.
And markets hate deceleration. They despise it.
So what's causing the drag? Is it a demand issue?
No, patient demand is still there. The demographics guarantee it. It's a mix of macro and specific headwinds. First, tariffs.
Can't escape them.
Management explicitly called out a 1.2% revenue impact from tariffs in the guide. That is a direct hit to the top line.
And margins too, I assume.
Absolutely. They guided gross margins to 67 or 68%. That's basically flat to down. You have the tariffs, and you have what I call the new product penalty.
Meaning the DV5 costs more to make right now.
Exactly. They haven't optimized the supply chain yet. So you're selling more expensive robots that cost significantly more to make, plus tariffs. It squeezes the margin.
A temporary squeeze, but it's there.
It's there. And then you have the international picture. Specifically, China sounds intense.
I was reading that they mentioned provincial tenders favoring domestic suppliers. That sounds a lot like protectionism.
Nationalism in procurement is the polite way to put it. There are local competitors in China now starting price wars.
So Intuitive is being forced to compete on cost, which is not a game they like to play.
Not at all. And if a hospital is told by the government, you must buy local, Intuitive gets locked out regardless of quality.
And it wasn't just China. They mentioned budget challenges in the UK and Japan, too.
Right. The NHS in the UK is always squeezed. When national health systems get tight, the first thing they cut is capital expenditure. They stop buying million-dollar robots.
So you combine tariffs, a China price war, and budget cuts in Europe and Asia, and suddenly 19% growth becomes 13 to 15.
It all adds up.
It makes sense. But, and this is a big but, Intuitive seems to have a strategy to fight back. And this was the part of the call I found most fascinating, the whole refurb strategy.
This is a brilliant strategic pivot. Remember all those trade-ins we talked about?
The old X's, right. So they take back this perfectly good, slightly used robot.
And they don't just strip it for parts anymore. They polish it up, certify it, and call it the Vinci AKR, the R being for refurbished.
And they placed 42 of these last quarter. So where are they sending them? Because it's not the top-tier hospitals.
No, they're sending them to ambulatory surgery centers, ASCs.
Okay, let's pause here, because I think this is the unlock for the next decade. ASCs, the strip mall surgery centers, they operate on much thinner margins.
They can't always afford a brand new $2 million robot.
But a refurbished one might just work.
It's not just the cost of the robot, though. There's been this argument for years that robotic surgery is too expensive for simple stuff, like hernia repair.
The sticks and rags laparoscopy is cheaper.
That's the criticism. But Intuitive came armed with data. They cited the Denmark study.
This blew my mind. A nationwide study. They compared the robot to standard laparoscopy for hernias.
And the clinical results were just ridiculous. A 50% lower risk of having to convert to open surgery with the robot.
Which is huge for the patient. But here's the economic kicker. For some hernias, the total cost was actually lower or at parity with laparoscopy. How is that possible?
Because you have to look at the total cost of care. The patients went home faster, length of stay was shorter, and crucially, readmissions were down 44%.
Ah, there it is. The hidden cost of cheap surgery is the patient coming back.
A readmission is a financial disaster for a hospital or an ASC. It's pure loss.
So Intuitive can go to an ASC and say, look, buy this discounted XIR system, the upfront cost is manageable, and oh, by the way, the data shows you'll save money on the back end.
It's an incredibly compelling pitch. It lets them attack the low end of the market with their high-end leftovers.
It effectively blocks competitors from getting a foothold in those lower acuity centers. Why would I buy a knockoff from a startup if I can get a Da Vinci?
It creates a wall. A wall of refurbished robots. It's defensive and offensive at the same time.
Okay, so let's zoom out to the investor context. What's the street saying about all this?
Sentiment is mixed, which explains the price action. You have analysts like Mizuho staying neutral. They're worried about restrictions on refurbishing in certain places, like China.
And then you have the bulls.
Like Truist. They're to buy with a 650 target. They see this methodical, training-led rollout as a huge differentiator, a moat.
Speaking of moats, the installed base is now over 11,000 systems.
That is the #1 competitive advantage. It's like the QWERTY keyboard. Once hundreds of thousands of surgeons learn to type on it, they don't want to switch. The muscle memory is locked in.
But the stock trades at a premium. The options market was implying a move of about 3.8%. We only got 2.7.
That tells me the whisper numbers were even higher. The buy side wanted to see a guide for 16 or 17% growth. Getting 13 to 15 is a reality check.
It forces a recalibration of the multiple.
You can't pay 50 times earnings for 13% growth forever.
So the debate continues. Beat on the quarter, drag on the guidance.
But the execution machine just keeps humming along.
Okay. We've covered the numbers, the tech, the strategy. Now it is time for everyone's favorite segment, the part of the show where we take off the reasonable analyst hat.
And put on the hedge fund cowboy hat.
Let's do it. This is not financial advice. I have to say it. Do not trade based on what we say. We're just two voices having fun with a thesis.
Understood.
With that said, pitch me. What's the trade?
Okay. I call this trade the junkyard dog arbitrage.
Junkyard dog arbitrage. I love it already. Unpack that.
The setup is this. Everyone is obsessed with the Da Vinci 5. The shiny new object. They're modeling the upgrade cycle, the selling price, the cardiac indication.
Right. That's the consensus trade. Go long innovation.
Boring. I want to go along the trash.
The trash.
Specifically the trade-ins. The Da Vinci CDs that hospitals are ripping out to put in the DV5s.
Okay, walk me through the mechanics here.
We go long intuitive, ISRG. But our thesis has nothing to do with the DV5. Our thesis is short, simple laparoscopy. We're shorting the sticks and rags.
Why?
Because Intuitive has stumbled on the ultimate weapon. They are taking inventory where they've already sold once, inventory with a zero-cost basis to them now, and they're refurbishing it for pennies on the dollar. And then they're flooding the ambulatory surgery centers. They're using their own waste to saturate the very market their competitors were trying to enter.
So if you're Medtronic or J&J, you thought you were safe in the ASCs because the Da Vinci's was too expensive.
Exactly. You thought, I'll sell my cheap tools to the strip mall surgery center because Intuitive won't bother. But now Intuitive shows up with a certified, good as new, Da Vinci XIR, with the Denmark data to prove it's cheaper in the long run.
It's a scorched earth strategy disguised as recycling.
Wow.
By the time competitors figure out how to build a cheap robot, Intuitive will have already filled every single operating room in every ASC with a refurbished Da Vinci. We are playing the secondhand dominance trade.
So the trade is long ISRG because they're about to monopolize the low end of the market with our high-end scrap.
And short anyone making manual laparoscopic tools because their cost advantage just evaporated. The moat isn't just technology anymore, it's ubiquity.
That is wild. It's ruthless. And honestly, it sounds like exactly what they're doing.
It's the junkyard dog. Not pretty, but it guards the yard. And if they pull it off, they lock up the market for another 20 years.
Amazing. Okay, let's wrap this up.
To recap, Intuitive delivered a monster Q4. Revenue up 19%, massive beat on EPS. The Da Vinci 5 supercycle is real. However, 2026 is going to have a speed limit. Guidance is slowing to 13 to 15% growth. Blame tariffs, China, and tough comps.
The company is pivoting to use those refurbished systems to capture the ASC market, and they have the clinical data to back it up.
And they're sitting on $9 billion in cash to weather any storm. So the question for you, the listener, is simple. Is 15% growth enough for you to pay this premium multiple?
Or do you wait for a dip?
That's the question. The valuation demands perfection, and they just told us 2026 might be slightly less than perfect.
As always, nothing you heard here is financial advice. Do your own diligence. Read the 10K.
And maybe check the manufacturing date on your surgeon's robot. This has been Talk Tickers, signing off.